everything we're talking about for our entire careers, as well as the history of the industry, has been easier said than done.
Hello and happy new year. I'm Jonathan Lawless and welcome to 2025's first episode of the Housing Insiders. For our new listeners, this is the podcast for founders, builders, lenders, and regulators, and anyone who believes that everyone should be well housed.
I'm Jeremy Potter. When we launched Housing Insiders last year, John, our goal was to share what was really going on in the housing space, bringing you those smart conversations, trying to find the people in the know. I mean, we combined actionable ideas, we had insights, and we're hoping you heard things you didn't hear on any other podcast.
Absolutely. It was a fun year last year. Thanks to everyone who listened in. We spoke to entrepreneurs, some policymakers, market observers, people who are really dedicated to making housing more affordable, and people who make money by forecasting the housing market's unpredictable ways. So, Jeremy, if you could sum up what we learned from our conversations last year, what would you say?
Well, there's probably some confirmation bias in here, John, but definitely how hard this is and how hard everyone's working at their particular piece of the problem, right? The complexity of housing is one of the things we were hoping to talk about. One of the things we uncovered is getting access to attainable and affordable housing, creating attainable and affordable housing, understanding all the complexities of the financing of housing were top of mind on pretty much every guest we talked to. That came out for me. I mean, just last episode, Jared Stasek talked to us a little bit about how to finance innovation and how the VC world looks at some of these tough problems and the teams working on them. The outlook for housing didn't get any more optimistic in our guests this past year. And then going into 2025, I think we can use a lot of what we learned to try to inform how we help innovators, regulators, policymakers, and business owners with their decisions.
Yeah, I thought
What
the
about
other
you?
thing that was kind of thematic on that point is this just the way that VC money is really incompatible with a lot of things that exist in housing, and particularly around things like modular. You know, we heard from QB about this. You know, I think that's venture money is definitely pulling back from the prop tech space. I think it's making some strategic bets, but I don't see that changing. And we definitely heard that in a lot of the conversations. And then, but I will say that, you know, a couple of the bright spots for me, the discussion with Hugh Frater a couple episodes ago, and what he's doing with Vessel Technologies, you know, just to me, it really struck me as like a very simple way to think about it, is that if you actually just buckle down, you know, make sure you're saving money everywhere you can, using the right sort of sources of capital. I mean, obviously demand for housing's off the charts. So there's just a lot of ways to actually make money, even building sort of workforce housing. So I don't know, I'd be kind of cautiously optimistic that that kind of model is going to work in the future.
Okay, I'll pick up on that theme because I like what you're saying. I was cautiously optimistic about the theme that we heard from Ivy Zellman about migration. Like, she was talking to us from Cleveland, Ohio, being a New Yorker who had relocated to Cleveland. And then, you know, our love, and I say our because Housing Insiders is a big support of the next belt, the Lake Belt up here. But I think that migration forecast for people looking at places that are sustainable, that have opportunity, where you can build, where you can make a life, whether that's a company or a house or whatever you want to do. I think I was cautiously optimistic hearing from Ivy about all those possibilities that she laid out for new housing and really new, you know, social movements.
Yeah, and totally. The other thing from last year is when the Indians beat the Tigers, it was pretty clear to me that if you were going to choose a Midwestern town to move to between Cleveland and Detroit, particularly, you'd probably choose Cleveland, right?
I would say if you're a baseball fan, if you're a football fan,
yeah,
it would
fair.
behoove me to tell the audience that you should be in Detroit this year.
Fair. We go to basketball, but let's move on. So the other thing, you know, to move on from optimism, probably the most notable thing we heard from our guests this past year, to me, was Ivy saying that the trend that she thought was most important in housing was the cost of insurance. And it just feels like since she said that, I mean, obviously it's been discussed, but I feel like since she said that, I've seen 100 articles just really kind of touching on that point. I don't know. What are your thoughts? Is that like really going to be a serious disruptor, derailer for a lot of things we're going to talk about in the next year?
I definitely think when you have high profile celebrity even voices talking about it. So I'll point to one of those hundreds of articles that followed Ivy's prediction, Mark Cuban weighing in on homeowners insurance, I thought was a notable, at least, voice, being that that now brings in the mainstream media, brings in the mainstream audience to say, oh, what's going on over here? If somebody who's not exclusively known for housing is now talking about it. So for me, it is a big deal, especially since, John, one of the things you and I bonded over very early on getting to know each other was the true cost of homeownership, the true cost of a mortgage. And one of the things that isn't fixed in a fixed rate mortgage is taxes and insurance. And insurance now, we're seeing places in the country that are so safe, quote unquote, from a homeowner's insurance claim, like the Dakotas, offsetting some of the costs that the insurers are losing in the higher risk places. So even if you live in Minnesota, North Dakota, South Dakota, your insurance premiums have to go up because it's a pool, a nationwide pool. So it is affecting the whole country, and it is projected only to get worse. What's your take?
Yeah, I mean, I agree. The only time I personally have ever missed a mortgage payment was because in the first year I had my mortgage, I set it on auto pay, and then my taxes went up. And then suddenly, like, I'm getting notices for being late on my mortgage. I'm like, what the hell? And it just turned out that my mortgage payment had gone up. And at that point in time, it wasn't a huge increase. I mean, what, $50, $100 a month. But, you get a fixed rate 30 mortgage and you think, okay, I'm set for the next 30 years. And
Yep.
when that is not true, especially in an environment where you think you're set because you got a 3% mortgage, that's real problematic. And Jeremy, your insurance went up. Am I right in saying that? I feel like you mentioned that.
I did both taxes and insurance. So I've been surprised a couple of times. One, when, it's not uncommon for a city to do, citywide tax assessment updates, especially if they haven't been done in a few years. So that happened in Detroit. So there was a taxes component to it. And then the insurance component, I think, is a combination of city risk and historic house risk. But my point is that, yeah, my fixed rate, my 30-year fixed rate mortgage, low rate mortgage that everyone talks about, I'm in one of those, not surprisingly. And it went up, $500-$600 a month just related to taxes and insurance. We've been pretty shocked by that.
That's amazing. And you're not even in a
Fortunately,
place where there's fires and floods. I mean, you're you're in sort of an ideal
exactly.
spot to not have to worry about that.
That will affect how people look at home ownership. That will affect how we pay for it. And one of the things you and I always get nervous about is, unless the private market steps in with an innovative solution, the government comes in with their solution. And so I think, to me, that's one of the big question marks here, is if insurers do actually start or increase the trend of just removing states altogether. We're not going to cover coastal California. We're not going to cover Florida. Well, what happens next? We don't want this to go the way of flood insurance, but I don't know what else is going to happen.
I mean, the fundamental truth of insurance is that when risk goes up, the cost goes up, period. There's no way around it. And so when climate risk increases the overall risk of significant property damage and loss, you need more capital somewhere to be able to sustain that. And it just means the costs are going to get higher. I mean, one potential thing is, it's just the new reality is insurance is going to cost twice as much as it did 10 years ago. And people are just going to have to pay that. And when you buy a home, it's just going to be a part of the calculus you have. I mean, the problem is not maybe where the cost ends up landing with elevated risk. It's just the way that it has to adjust over a period of 5-10 years that just really hurts people who think they were kind of locked in. So, I mean, but to your point, the only other way around it is you find a much cheaper source of capital, which is the government comes in and steps in and sort of subsidizes the capital cost to keep those costs lower. This administration, to me, sounds like they would favor the former approach. In other words, if the risk is higher, you've got to pay for it. And over time, we've just got to reach this new elevated level. And maybe we just try to ease the pain of the adjustment, but ultimately get there, versus really stepping in and subsidizing it.
Yeah, that's a call to innovators, in my opinion. So, this podcast was in part a challenge to innovators, and this sounds like the perfect opportunity. Can you make a house more efficient? Can you lower energy costs? Can you do things that fund resiliency? Houses that have been either gone through a mitigation or some sort of risk resiliency relative to fire risk or hurricane risk, we now know they do better. They do better when those natural disasters strike. We have data that shows that. So I would say, how do we start incorporating more options, whether financing options, resiliency options, technology options? We can start at least taking small swings at some of these costs, whether or not that helps, like, communities pay less over time or individual homeowners pay less over time. I think what you're saying is like, let's at least just flatten as much as possible the cost increase, because that's just the nature of everything, every cost. But if we can flatten it, that is actually going to have a really good impact for homeowners in the next 10 years.
Yeah, interesting. I mean, I'm sort of having this very random thought right now about if your insurance costs so much per year, at some point, doesn't it become worthwhile to build like a force field around your home? Like imagine like sort of this automatic airbag that shoots out of the ground and covers your home in the event of like, which sounds ridiculous and expensive, but if insurance is really expensive, maybe at some point you start to see maybe not a force field model, but like something that is equally
Yeah.
protective of the home that costs a lot of money. You think, boy, I would have never bought that in the past, but now if I buy it, my insurance costs are $100 a month versus $10,000 a month, or I can actually get insurance. It might be worthwhile investing in.
Yeah, your house can become like that of a Bond villain, where like the barriers go up, almost like garage doors, and become an entire like force field around your house. I was actually going the other way, John, which was, could you not insure your house, right? Self-insure, and then just build yourself one of those modular or factory built houses on the same spot. And we actually just become like, instead of paying however much it is over 10 years every single month, I'll just wait. I'll just have my modular house built in the same spot.
Yeah, interesting. Yeah. Use 3D printing to build a cement home that you know it'll survive anything. I mean, again,
At
it's
least the shell will.
different form of capitalizing. Well, let's now that we're talking about looking ahead, obviously the biggest topic in housing, the one that's come up in every discussion, is on housing supply. So I guess one of the things to think about are, going ahead is, will we actually see something actually move the needle on housing supply? Not to say that we haven't seen some interesting trends in the past year that are worth watching. The YIMBY movement has made some appreciable, change in certain markets around ADUs, and you see Minneapolis starting to change. So not that there hasn't been, but is there something that's going to happen going forward that's going to really move housing supply?
Yeah, I wanted to ask your opinion on something, John, which is, we look at some of these example cases and then we try to extrapolate them over the whole country. Minneapolis gets brought up a lot as a place that has made those strides that you were talking about. I think Montana was another one we heard at an event recently, the governor of Montana making these strides. So I'm curious if, from your perspective, when you look across this, what the relationship between funding housing and the policy framework that the funding has to flow into. Can you talk a little bit about, are we talking about just like two sides of the same relationship here? Or are we talking about, one is the shark and one is the remora that just hangs out on the shark? How do you feel when you talk funding versus policy?
The other wild card I'd kind of throw in there is sort of what are these sort of broad demographic trends that are going to sort of dominate the market as well, because you've got funding and policy are obviously closely related when it's government funding, and is there a government policy that is enabled by a special source of subsidization? Private capital is just kind of follow where the market is, and probably follow, I mean, to your point, 10 paces behind, because you don't want to get overextended when you're sort of investing private capital and make bets that are too far ahead, when right now private capital knows it can make safe bets very continuously and make a lot of money. And so I've become more increasingly convinced it's public funding that's going to really need to step in a different and new appreciable way to make a meaningful change in supply. And I continue to think that public funding and subsidizing increased density in existing overpopulated cities is the worst way to spend it. And I say that just because more and more so the articles that I'm reading, things that I'm hearing, is really about this sort of new millennial generation who wants space, who wants sort of a confusing mixture of space and walkability. You're just not going to find space in the most walkable parts of cities these days. And so I have to think that trade-off is well, I'm gonna, to use a quote that our producer brought, drive to qualify. I'm gonna move out to a place where I can actually get enough space that I can actually qualify and afford the home. And that movement trend, I think, is just going to dominate. Again, these are slow trends, but as that trend starts to become real, I just think it's going to dominate the supply discussion.
You mentioned something that really struck me because we've been sharing a lot of these articles and we'll continue to share these links through the podcast. But one of the interesting correlations that stuck out to me was this idea between like mass psychoanalysis and housing, meaning that housing really goes to like this kind of mass belief about my community, about me, about my city or my town. We know fear is the strongest emotion. So there's a question of this like, you kind of teed up what sounded to me like if you build it, they will come, right? The famous line from Field of Dreams. But this question of like, what do people really want? And can you trust that if you built it, they will come? So if this drive to, I'll drive to qualify, I'll keep driving out from a city until I hit somewhere I can afford is real. There are cities, the idea that cities can be a vehicle and you could just make a new one, I think is really fascinating. And it goes to this question of, I guess, combination of like fear and hope, because you're saying urban infill doesn't happen because of fear, right? It's like you're changing my community. Also, it's hard. So hard plus fear. A lot of the not in my backyard stuff started in cities and then went to the suburbs, right? And now the
Hmm.
not in my backyard is getting wider and wider. But the reality is, if it's nobody's backyard, then there's nobody there to oppose it. But now you're building a net new city.
Yeah, I mean, I would recharacterize the fear point that you made to be a little bit different, which is infill doesn't happen is
Okay.
because nobody actually freaking wants it, and that's I was reading this interesting. I'm reading a book that's talking about the history of the city of Philadelphia a little bit and the housing that was created there, and when Penn sort of created Philadelphia, he had this sort of grid system where every lot would be a half acre, and sort of thinking this utopian lifestyle of these like half acre lots for every home to me, evidence is like people want space and open areas. Now, I would say 20 years ago, the biggest generation of America wanted tight, small spaces where they could live close to things that were fun. I just don't think that's where we are today. So I think, again, I call it fear, but I sort of call it like, what is the market demand? And the market demands space, but they also demand commutability. And so this sort of trade off that you and I have sort of really grown up with, which is like, you can't have both. So if you want to live close enough to get to work, you have to sacrifice space. But if you want to have really good schools and space, you have to sacrifice commute times. And it's just like a really, almost like a silly thing that we sort of forced upon ourselves. But to your point, and I to sort of like pivot a little bit to the other point that you're making, which is the market is going to say, okay, millennials want space. Well, I'm just going to give them a bunch of McMansions in areas that are an hour outside of every city. I'm going to build all these sort of tract cul-de-sac housing developments, which, God, they make me want to vomit. I think they make most people want to vomit, but if you want space, that's what the private market is going to give you because they can do that so easily, so cost effectively, and make money off of it. And so, to your point, the field of dreams sort of, I use another characterization, which is in a great article that I read recently and that we have been talking about this article, Microcities, by a guy named Waldman, I think. Anyway, he sort of uses
Mhm.
the quote "bridges to nowhere," like, oh, they built a bridge to nowhere. And the reason the government builds a bridge to nowhere is because it's only the government that's able to take a risk like that and hope that that nowhere becomes somewhere. And so the question around sort of housing supply and to your point, policy and funding, if the Trump team were to say, we want to open up new land, or we want to revitalize old cities, or we want to build new places and make the investment around the infrastructure so that private market will come in and build something different besides McMansions. Like we're going to create the groundwork for a new form of housing that combines walkability, that combines space, that combines mixed income. That to me has real hope. Otherwise, it's hard for me to see infill being successful or these sort of tract housing McMansions being successful. So I think the role of public funding is to really change fundamentally that dynamic.
And I think you're where we disagree. I was going to say you're right and wrong, right? In my view, just
I
how
usually
we
am.
think about this, which is I actually think that if we were really to unpack this mass psychoanalysis that I'm talking about, that people actually do want density, and they want density that feels that it is theirs, that they're a part of it. And so when we think about, like, I'll take boomers and retirees as an example, they go towards density. Now, it's been in the past kind of like a little bit more space to your point. So that's where I'm agreeing, where let's live in a community in Florida. It's a relatively dense community by other standards, but I have my space. Other retirees go to, college towns, Ann Arbor, Columbus, Madison. Those are fairly dense little cities. And I think that people actually do want that. I think what people resign themselves to, and this is why it's psychoanalysis, is they sort of go, "Oh, I guess I'll move out there. I guess I'll move to the cul-de-sac." They don't seem particularly proud of it. The way people do seem proud of their neighborhood or their town when it is uniquely theirs, and it is dense, fairly dense, I would say. And so I think the question we're asking is, how do we give people that experience with a net new city when there's a tremendous risk there that you talked about?
I guess, you brought up different demographics. Like if you sort of break the world down into the 25-year-old, 45-year-old, and 65-year-old, let's say, and sort of say, what are the housing needs? You're right. And you've often talked about this. Like we really love our time in college because you're right around all your friends, you're living together. And then we all move away. And then when we get old, we sort of move back in with each other in sort of these retirement communities. And like there's sort of this drive towards that desire for that lifestyle. Maybe sort of the thing that we're kind of agreeing on is that there's this moment between 25 and 65 where you have kids and they sort of create this need for space, but you don't want to give up the community. And I was sort of thinking about this term because a lot of people use this term walkability because they love walkability. Like they think that's like the best feature of a community is walkability. And I've got to say I totally agree with that because I despise having to drive anywhere where I live. And it's purely because of that. Like to get into my car and drive 5 miles is like it's like an hour, and that's just like absurd. I could walk 5 miles in an hour. And so I think probably, but you go back, like if I think about when I grew up in Ohio, my dad would drive 30 minutes to work and it was 25 miles away, like, and so part of what I think people really demand is commutability, right? The ability to get to places where things that you need are without the misery of it. And like, yeah, I love walkability, but honestly, I hate getting on the subway at 8:30 in the morning when I might not be able to get into a car because there's so many bodies pushing and shoving to get there. Like that is not the walkability I want. The walkability I want is to be able to stroll down a sidewalk, walk into a cafe, and then go across the street and go to my office. And that seems to be like the real desire. And like, again, you can't have all of those things. Like, and so the question to sort of bring it back, like, what kind of walkability does the 45-year-old generation really want? And is it sort of dense city living when you have two kids and a car and you want to walk places? Is that sort of the ideal? Or is it denser suburban living where it's not the suburbs of our parents' generation, which was like you could easily drive, 20 miles to get to a city and feel comfortable with it. But it's you need to have a suburban lifestyle where the things that you like are not an aggravating commute away. It's a commutable lifestyle, maybe as much a even walkable to some degree, but commutable community that you could be in and still have the space that you need to raise children.
Yeah, that's right. There we agree on. Would the demographic we just described, that kind of plus or minus 45-year-old family, would that demographic sacrifice square footage for closer access and easier access to a variety of things? And I think what we're saying is the resounding answer is yes. That's is like we believe that the flow of demographics is going that way, and we'll see if we're right.
Yeah. Well, I mean, I don't know. Maybe you said they would be 100% willing to sacrifice square footage.
Square footage in particular, because I think what you meant is, or I think what we're saying is space, and kids and families require a certain amount of space, but maybe not so much space of your own. It's just space to go places, right? Like You have to be able to go to the park. You have to be able to go to the cafe. You have to be able to go, whether it's 5 minutes walk or 5 minutes drive. I guess my point is, if it is set up that way with that in mind, that's a very different thing.
Yeah, I don't know. I still when we talk about square footage of space on your own, though, this is kind of an important distinction. Is it a
Yeah.
1,500 square foot 2 bedroom condo in a city? Is it a 2,500 square foot 2.5 bath 3 bedroom, house in sort of a tightly knit suburb, or is it a 10,000 square foot McMansion, in a cul-de-sac out in the country? I think it's sort of that 2,500 square foot ideal is the place people want to be, right? They still need space for themselves. They still want a yard. They're not going to be okay with, with honestly what generations in the past were okay with, which was, immigrant communities in the 19th and early 20th century came to America and lived in small flats, and they thought that was totally fine. I just don't think that's where we are as a country. I think the desire is going to be for a 2,500 square foot home that's still in an area that's commutable. And again, is that in a city? I don't know. I don't envision that being in a city I know today. I envision that being the case in a city that gets recreated or redesigned in the future. Because that honestly is Detroit. I mean, most of Detroit is sort of designed around that 2,500 square foot home that's on a major avenue that goes into the city, and that used to be very workable in 1950.
Mhm. I think I'm trying to separate my bias living the exact life we just described in a
Right.
2,500 square foot home that I can walk to everything, and I do. I think I'm trying to be objective and say, like, but if it was a 2,500 square foot townhouse, would I still be happy? I guess what I'm trying to say is, if it was a duplex, if it was a quad, if it was a row home, if it had the square footage that is around that number we're talking about, and you could still walk out the front, right? If you built a Midwest city with brownstones, but they were 2,500 square foot brownstones, you'd be all right. You would have demand. Like, people would buy those, is my view. And I guess that's the thesis I'm throwing out there that we'll see. But
Yeah.
that is how I was thinking about it.
I think just maybe to wrap up this conversation a little bit, I guess the fundamental challenge is it's really hard to predict this sort of intersection of what people want, where they want to live, what we should do. And so if you're a builder, you're going to just place your safe bet. What did I build last year that made me the most money? I'm going to build that again this year. And if you're a policymaker and you sort of get into this discussion of like, what should we build, or where should we emphasize? You start, these could really make you question yourself. Like, do I need to build a bunch of more townhomes closer to cities? Do I need to open federal lands and build a bunch of single family homes that are 2,500 square feet? What do I do? And it's almost paralyzing and hard to make that decision. And, I guess at some point somebody's going to have to make a major bet in a different direction than where bets have been placed. If you're a policymaker, you're going to have to pick one of these theses and just go into it. Otherwise, if you're going to make small bets, we're going to be in the same supply situation that we are in for until demographics shift and we have a different problem.
That's right. I think the thing that I hope our public officials do is make some of those bets. And I think it's a great way for cities, especially small towns and small cities, to differentiate themselves. And we've seen that type of branding work in small ways. It'd be interesting to see if going forward, cities and towns start branding themselves with some of those big bets. I would welcome that. I mean, that couldn't make me more excited as a housing
Great.
insider.
I hope listening to this conversation is as fun as having it, because it's certainly a great and interesting topic. Let's take a quick break here before we jump back in and talk about a few other things. This episode is brought to you by Built Rewards. Built is a rewards program, just like an airline program that is centered around your home and neighborhood. But instead of earning miles for flying, Built rewards you for paying rent, no matter how you pay. As a member, you can earn points at over 20,000 local restaurants, local merchants, and those points are now the most valuable rewards currency. You can use it to book travel, on Amazon, or even towards a down payment.
Built is revolutionizing housing. If you want to learn more, email John at lawless@builtrewards.com. Welcome back to Housing Insiders. John, we're talking about what we learned in 2024 and what we can expect to inform 2025. So, with that in mind, can we talk a little bit about the financing and lending of houses? We've talked a lot about housing supply. We've talked a lot about housing policy. How do we get some of the sand out of the gears for lending and for housing finance. So let's talk about it in the context of like breaking news. Let's talk about it in the context of partnerships and other things we've seen hit the headlines. What do you think has been the biggest kind of lever for lending in the future as you've seen it from our episodes and our guests in 2024?
Both you and I happen to be in a unique position now where we're sort of thinking about what lending looks like in the future for our job, in the sense that we're like really uniquely positioned to try to re-envision what it looks like. And I think a lot of that's, in my opinion, has to do with sort of owning the life cycle, right? Squeezing out some of the costs of lead generation from the various points in the sort of housing journey, housing purchase journey. And I love the way you've articulated in the past, like we use 6 licensed professionals now to close a home. It's really kind of incredible. And how do you start squeezing those together so there's less fat in the system, if you will? That is the context. And I can't wait to hear you talk about this. But ending the year, we had this lawsuit against Rocket Mortgage around I guess a RESPA violation where real estate brokers were effectively steering people to specific lenders, in this case, Rocket. And I'd just love to hear your lawyerly and also sort of business take on that specific lawsuit.
Well, obviously, it piqued my interest having been at Rocket Mortgage for 5.5 years and worked very closely with Rocket Homes. I think the thing that caught my attention was, Rocket Homes is a real estate brokerage, but not in the traditional sense. It is a real estate brokerage that is a network of other independent agents who utilize technology and services to do their job and also to connect those real estate services from consumers who have called into Rocket to get everything they need on the Rocket Mortgage side. So there's a natural tension there. There's a natural desire for the Rocket Homes network of agents to send business to Rocket Mortgage. What this complaint claims is that there were incentives, kickbacks, RESPA violations that encouraged or steered consumers from that network of independent agents into Rocket Mortgage. So when you look at it on its face, can even $1 violate RESPA, a $1 incentive to recommend a mortgage company? Sure, that is the specific language of RESPA. That can be a RESPA violation. The thing that bothered me about this the most was missing the forest for the trees. When I read this complaint, it reads to me like an independent agent who's the biggest independent agent actually in the country, but also of the Rocket Homes network, was doing contests and other incentives to give away gift cards to top performers who were measured in part by sending business to Rocket Mortgage. So you're an independent agent, you're working for an independent broker, and you are part of this technology network, this leads network, this referral network that is built to help ease the consumer experience. Now, whether or not a $250 gift card is incentive enough for an agent aside, I would argue it's not at all. But that aside, the complaint also misses whether or not the consumer got a good deal. And this is the thing that's always driven me crazy about RESPA is the complaint basically says, because of monthly contests where a top person got a $250 gift card, it's clear that they were steering consumers to Rocket Mortgage, which may or may not have been a good loan. Forget that it's been impossible to define a good loan. Now we're not even sure that anything even happened. And I just can't deal. Like, I want our regulator looking at the real problems of the industry and the real constraints on cost and competition. And this
But
didn't feel like a real bona fide
I'm surprised.
complaint
I
to me.
get your point that it's sort of like a gift card feels like a very weird way of steering. However, I mean, the whole reason that RESPA exists is because if a real estate brokerage has a special relationship with a mortgage lender where it's a quid pro quo, I'm going to send you leads, you send me leads. And at the end of the day, they're not potentially getting the best mortgage. In other words, brokers like, look, here are 3 options, but man, if you want to get the best mortgage, you should go to Rocket. Maybe it's the best mortgage, but that broker has effectively steered that customer to a lender because they have a relationship with that lender and expecting leads in return. That to me seems dangerous. Now, all that being said, I mean, the part I agree with you on is that these things seem really like they're hand in glove, like they're part of the same process. If the real estate broker was the loan officer, and they sort of said, I'm going to both help you shop for a home and help you shop for a loan, then you'd sort of say, okay, I kind of see that. So anyway, I hear what you're saying about sort of the complaint being very minor. But on the
Well,
other hand, how do you really avoid what RESPA is trying to avoid, which is brokerages having this kickback scheme with the lending organization where effectively they are steering consumers and discouraging them from shopping in return for having this relationship with a lender that's going to send them leads?
I think you described it in exactly the right way, because I could also describe the way that a real estate agent tells someone not to go to Rocket or not to go to better.com because they're a national digital lender and I don't trust them. You have to go to my local guy on the corner is exactly the same thing. So my point is the CFPB doesn't want to actually look at that and actually say, oh, because of technology and transparency, we can see that this system was flowing the way you just described. But without technology, we can't see how many agents all across the country say, don't go with Rocket. They're just a big digital lender. They don't care about you. They don't even know you. Go with my guy. And they got a worse rate going with my guy. And I'm not
Yep.
saying they did. They may or may not have. My point is, we're not actually looking at the fundamental workings of the system. That's one. Two, you made a great point, which gets me all fired up about the fact of what is actually good for consumers. And Bob Walters, the former CEO of Rocket Mortgage, used to say this, and it really made an impression on me. Consumers are like us. We want what we want when we want it. Right. And why wouldn't we? That's what it means to be a consumer. I want what I want when I want it. So, to your point, John, we got to do a better job offering exactly the answer to the question, exactly the transparency needed, exactly the visibility and data modeling needed when a person needs something. And we do a terrible job of it in this industry because of the handoffs between real estate, mortgage, and title, because of the way disclosures operate at the timing of disclosures, and of course, RESPA. And so those three things stacked up make it very difficult to actually give the consumer what they want and need at their moment or point of need. And instead, we force their needs into our model. And that has to change in 2025.
100%. Yeah. I guess, and maybe this will kind of pivot into, if you're really trying to rethink the lending ecosystem in 2025, what model, what does that look like? And I guess part of the way you avoid the RESPA problem, in other words, sort of let's take every aspect of it from the realtor to the loan officer to the inspector to the appraiser. Like, what you want to make sure of for the consumer is that they are in fact getting the best possible deal throughout every piece of that cycle. And the only way you can really prove that is to be legitimately giving them the best deal. And so I'm sort of thinking a progressive model, which is I'm going to show you my rate, but I'm also going to let you or connect you with 4 other lenders and you can see all the rates, and maybe mine will be the best and maybe it won't be the best. And in which case, if my title policy is not the best and somebody else's, go get their title policy and you can use me for the other pieces. But I wonder if that's kind of the model, because truthfully, if you're able to squeeze out the administrative costs of trying to acquire customers for every part of that life cycle, if you could squeeze that out, you should be able to compete and be at least regularly in the mix of the lowest and best price. In which, I mean, these things are commodities anyway. So if you can compete on price and stack them together and show them and show policymakers that I have not steered them into the wrong product, I've given them every possible option, they have just taken the best one at every point. Maybe that's kind of the model that I'd at least envision. Squeeze out costs, show competing rates, show competing prices legitimately, and then let the
Yep.
consumer choose what they want, but give it to them all right when they want it instead of them having to do the shopping, honestly.
Yes, I agree. I think you're spot on that. I really like your progressive insurance kind of model for housing and housing finance. And I would say that to me, technology and the internet as a subset of technology is the kryptonite to RESPA. And what I mean by that is it can fulfill the vision to say, I wasn't steered. I did have transparency. I made a choice. You know how I know? Look at the screens I saw. Look at the journey I went on. And if a lender an all-in-one platform could show that. So where you are sort of modeling the progressive insurance dynamic competitive marketplace, I think my thesis is going towards the all-in-one platform. That the first movers of all-in-one real estate, mortgage, title, insurance, all under one roof, I think the first movers weren't wrong. I think they were just early. And I think the vision will be using technology. AI is another subset of technology, of course, because you have to extract cost. But using technology, using transparency, you can actually show a fully informed process and actually have a person end that process not in tears, as 54% of first time homebuyers, 52% of first time homebuyers end in tears, according to Zillow. You can actually have that person end pleasantly surprised or even happy that they
Yeah.
went through the process with you if you can show that. And I think with technology and some of these other things, I think you can.
The only problem with the all-in-one platform is you have to own the consumer from start to finish, and you have to have a level of trust with them before they start to really get them through the whole every piece. And there are very few organizations. I hope Built is one of those, obviously, is that we have renters early on in their journey. We can build trust with them to sort of walk them through the full journey. I think other organizations like maybe a Zillow have developed that sort of level of early on trust. The Rocket brand is obviously one that everyone knows because of their very strong marketing and advertising. I think the all-in-one platform kind of requires this. Before you even go into it, you need to know that you should start and finish with this same brand because it's the one you should trust. That is hard to build, and I think that's also where the all-in-one attempts of the past have struggled. But anyway, let me just ask, what other aspects of lending do you see having true, are sort of changing the dynamics of, what a lender might look like in the next year?
Yeah, I think of a couple. I mean, the two probably biggest levers. One is you just mentioned cost of acquisition and referrals. And if real estate brokerages, real estate agents, real estate as an industry starts taking a harder look at mortgage or a deeper look at mortgage to try to make sure that the consumer has a better experience. And why would they? Because of what you just said. The consumer is in the consumer's first instance talking to the real estate agent or interacting with real estate when you shop for a home. So there is, I think, the most powerful relationship and the most powerful trust you have.
Yep.
If that's
Yep.
true, why hand that trust off? They've been handing that trust off for years. And I think this lawsuit, the NAR lawsuit, combined with the competitive landscape, will actually change the dynamic for lenders going forward. Then I think the other thing is technology is helping compress the cost of funds, right? So we're actually seeing technology jump in kind of these like under the hood kind of loan delivery ways, which seem boring potentially, but are actually really meaningful when you can get a loan from the closing table to the investor in 24 hours instead of 24 days. That is a tremendous advantage because now you can pass, or you should be able to pass through those economics back to the consumer. And somebody will use those economics to drive down the cost of mortgage instead of buying an NBA team. But eventually, those economics through competition will get to the consumer.
Well, you mentioned a commercial from Ally, which I want you to talk a little bit about,
Okay.
or how you think about it. But as part of that, I mean, we've talked about AI with several guests, and obviously, it's a topic everyone's thinking about in the tech world. And a lot of what I'm seeing recently in the conversations for 2025, at least in some of the articles from tech platforms and Wall Street Journal, so on and so forth, is this agentification of AI. So, in other words, AI becomes an agent for you that can actually execute and do things for you. I sort of see your thoughts on Ally that you shared with me in tension with this sort of like, how do we make technology drive more of the process, and technology, particularly through an AI agent who can be a human that actually helps you through what is a really difficult decision. Anyway, I'd love your thoughts on like, can AI get there, or is that 10 years from now?
Yeah, when we talked a lot about AI this year, we talked about how AI is helping, particularly marketing communications, inbound customer communications, and sort of loan officer or real estate agent assistant type roles. That was kind of the big three uses of ChatGPT. Was I can help you with your marketing, I can help you with all these tasks that you used to do manually. Now you can just generate AI, either content or AI triage that really empowers people. But what I didn't hear that I'm really curious about is where I saw it going in banking. This Ally commercial that you mentioned was around concierge customer service. And still, in the Ally commercial, still having a person. We have a person on the phone talking to you. We have a call center. When you call in, you get a person just like you to help you through the process. What I'm suggesting is that's the right way to think about it. Concierge is the right word, but to make that cost work and not add cost to the system, that person has to be equipped with a dashboard that gives them every piece of information that they have, making the lender, Ally Bank in this case, but any lender in 2025 we're talking about, feel like they know everything about you, as your wealth manager would, or as Delta Airlines would, or as Amex or Disney would. When I called Delta, they literally ask you straight away, are you calling about the flight you're on January 3rd? Is this the flight you're talking about? Because we can see that you're on it, you're going here. No, it's actually a different one. Great. Who do you want to talk to? That level of visibility in the dashboard can still empower a person-led, human-led concierge floor, but they have to be equipped with exactly where you are, the last time you called, what you're dealing with. And I think AI is capable of that. But even if you don't use AI, you got to figure out a low-cost concierge model or you're going to be out.
Interesting. I mean, I think probably every lender who's dealt with a customer knows this, and I think I've recently learned it because I actually interact a lot with our members who are in the process of buying a home. And I wish the questions that I got were easy, but I have to say, 90% of the time they're complicated and hard. What I'm saying is that, like, you can't outsource that to somebody who doesn't really know what they're doing. You need somebody who really has deep knowledge of how this system works to be able to engage with questions like that and provide the level of comfort that consumers really need. And I wonder whether or not AI can help equip less expert concierge assistants, whatever, be able to answer really tough technical questions at a cost that's not hiring a bunch of experts. But I think, this idea of all-in-one platforms, customer acquisition, and figuring out the human touch aspect of it is the problem. And I don't, now that I sort of say it, I don't know if that's necessarily a novel way of framing the challenge, but I certainly think the context we find ourselves in, RESPA, the new administration, the advantages of AI have sort of shaken the system up a little to make re-engaging that sort of overall challenge a worthwhile one to do.
Yeah, and I am sensitive to the fact that everything we're talking about for our entire careers, as well as the history of the industry, has been easier said than done. I am aware that everything that I say is easier said than done. So we are sensitive to the fact that the reason we're here in housing, the reason we're here in housing finance is because of how complex and complicated it has been, and whether technology is an ability to relieve that pressure, a pressure valve release, remains to be seen. But that kind of leads us, John, into like a key question for you and I to close out the show here, which is, are any of these themes, is anything we talk about causing you to make some big bets in 2025? So I'll start with my question and we'll go from there. But if mortgage interest rates were to go up 100 basis points or to go down 100 basis points or 150 or whatever it is, what would that mean? And would you do anything differently? Let's start there.
Yeah, great question. I like the framing of it. I mean, nobody knows where interest rates are going to go, but they could go anywhere. So I think, when rates go down, home prices go up. I don't think it's a huge difference, but at some point, rates go down low enough where this taxes and insurance problem becomes a real issue in some areas. I am convinced that if rates go down, let's call it to 5.5%, you actually see people making the decision to move out of expensive climate impacted areas. And I think that creates significant decreases in home prices in some really highly sensitive areas. And so my sort of thought for policymakers is be wary of this risk of home price declines in some regional markets that happen as a result of people suddenly walking away from second homes or whatnot, in particularly high insurance, tax insurance parts of the country. So that's on the downside. On the interest rates going up, I mean, it just continues to put a stranglehold on the industry and just, I think, make it even less interesting to invest money. Can interest rates go high enough where home prices actually go down? And I think the answer to that is, like, unless there's a meaningful reason for people to put their homes on the market and sell, and for inventory to take a jump up, interest rates go up. For everybody, it's like, we're going to have to wait a few more years till things normalize and wages go up. And it's just bad. I don't know that there's any particular bets I'll take. Anyway, what are your thoughts?
Yeah, right on. I think that, I kind of subscribe to the 80/20 rule for mortgage companies. When 80% of the businesses refi, things can run fairly smoothly. When 80% of the businesses purchase, things can run fairly smoothly. The operational challenge mortgage companies are going to have this year with the volatility you mentioned and the uncertainty you mentioned is it's not going to be that simple. People do a cash out refi when they have a life event and need cash. People sometimes sell a house when they have a life event and need to sell a house. That's the business going forward. And that's kind of a mix of business. That's a 50-50 market where half your pipeline is more complex cash out refi and half your market are these purchase, and that's hard. It has been historically hard for mortgage companies. So the ones that are going to be best prepared are going to be the ones that can manage that with headcount technology and other advances that they've made, and the ones that are going to struggle didn't make those changes and are just going to be juggling a more complex pipeline than they've been used to for the past decade.
Yep. I'll just add for next year, one thing that I have been thinking a lot about is something that I think Ivy said as well, but Hugh really reiterated, which is, maybe one of the best businesses to start in this industry. Because as you just described lending, it is going to be a slow velocity, low margin business, which sounds god awful. But the truth is, if you can just build homes, it's a really good business. And so, I mean, if I were thinking about the business to start, it's not a VC backed, let's make the process better and more interesting, at least not now. It would be, let's go get normal capital and try to figure out ways to build homes. And I think that's actually a meaningfully profitable business to start in the next year. The last question, as we kind of round up, we talked to Jeb this year, kind of going into the elections about predictions for what both campaigns were going to be doing in terms of housing. So now we've got the answer. We've got the Trump administration. What do you think happens in 2025 with the Trump team? Where are you placing your bets?
Well, I will say this, John. Intellectually, I'm excited by the fact that anything could happen, but emotionally, I'm a little scared by anything can happen. This idea of the uncertainty, I think, probably makes CEOs a little bit nervous because CEOs and shareholders in Wall Street tend to like certainty. And when you don't know and anything could happen, it's equal parts exciting and scary. For me, the one big thing that I'm betting on that it seems like many of us are overlooking in housing is just how dramatic and how fast GSE reform may happen. And I know that sounds weird in the context of probably the slowest moving topic and the most complex topic of the last decade. But in my opinion, if there is a swift action taken to get Fannie and Freddie in the hands of private shareholders subject to their regulator, I think it's going to be faster than we think, and I think it's going to be more dramatic than we think, and I think it is going to happen. And I think that's probably a bolder bet than a lot of others in the industry I heard who are taking a more middle of the road view of, oh, it may, but it's going to be hard and complex, and so it'll be an ease in process for everybody. And I guess I'm just taking I think it's going to be swifter, and I think it's going to be more focused than people are prepared for.
No, I think that's a great guess. I mean, on the GSE reform point, this year, there's tax is going to be the big thing, right? We've got tax bill that's going to be needed to work through, and I think it's going to really suck the oxygen out of the room when it comes to financials. Period, for the administration and for the legislative branch, and it makes it hard for me to think that GSE reform gets any airtime. What then becomes the big question is, at the time of this recording, Jeremy, you're making that bet not knowing who the director of FHFA is going to be, or not knowing some of the meaningful positions at Treasury that are going to make the decisions. But if the right people are in those roles, they're not going to need a lot of assistance and guidance from anybody. They can just go and start doing things. I think the sure bet is the GSEs are going to have some handcuffs on them. Preparing them for a major privatization means that sell as much risk as you can. Maybe we see more reinvestment in the CRT program, maybe new interesting forms of insurance to sort of lay off the risks and the capital needs for the GSEs. Certainly eliminating some of the duty to serve, affordable housing goals, racial equity objectives the GSE have had, really sort of clamping down on pilots and special programs and initiatives. So if you're a lender and you're thinking, oh, I'm going to go ask the GSEs for this special change or special programming, good luck. I think probably what's going to happen is the GSEs will be put in a position where they must be preparing for privatization in the coming years. And that to me seems as sure as anything. Now, whether or not they prepare, and then there's enough attention, focus from other agencies to actually do it, I think is the question that hopefully will get answered in 25. But I don't know that any progress will be made on that specifically, given all the other priorities, including, and again, I don't know how federal land gets opened up for development or what that looks like. Some of these other sort of housing thing, energy policy, and the effect there, tariffs, how does that affect housing? Like, I think there's a lot of other open questions. I don't want to even try to make a bet on what those things imply. My guess is too many other things going on in 25 for any of those things to make any progress. If I had to bet, that's where I'd put my money.
Right on. Well, thank you, John, for the perspective that I've gained listening to you over these first dozen or so podcasts. And I cannot wait
Likewise.
for another year of Housing Insiders together. So we're going to tackle all the issues of housing, the complexity, how to make it more attainable, how to make it more affordable. And for sure, we want to hear from you. So please reach out to us, guests, topics. We want to make sure we're having this conversation broader than just the two of us.
Yeah, and the way to do that, you can email us at podcast@thehousinginsiders.com. But Jeremy and I are very active on a lot of social platforms like LinkedIn and other things. I mean, the goal of this podcast is really to create a community of like-minded individuals who are thinking about housing in a serious way, who have insider insights on housing. And so please, reach out to us through the email or reach out to us through social, and let's really engage on some of these topics. Disagree with us, suggest other topics. But I think most importantly for us, so that we can continue bringing all this content to you, is subscribe. Subscribe, comment, like the podcast. It really helps us out a ton. And we really appreciate to those who have listened so far this year and to those who are going to listen to us in the future. So that does it. Thank you very much. Jeremy, thanks for a great year. We'll talk to you again soon.